When Warren Buffett was a mere 25 years old, he embarked on his inaugural investment venture by establishing the Buffett Partnership. This investment firm thrived from 1957 to 1969, during which Buffett accomplished an impressive average return of 29.5%. What's intriguing about Buffett's investment approach is his preference for straightforward methods, eschewing complexity to attain remarkable returns. According to Buffett, investing isn't a contest where the person with a sky-high IQ of 160 outperforms the individual with a modest 130 IQ. Rather, rationality is the cornerstone of success. Therefore, the key to achieving substantial returns lies in rationality, adhering to simple strategies, and unwavering commitment, even during the challenging times. Now, in this video, my aim is to impart 7 investing principles derived from Warren Buffett's playbook, which have contributed to his extraordinary returns. However, let me clarify that duplicating Buffett's astronomical returns may not be feasible for everyone. After all, he has dedicated his life to investing and possesses immense wisdom. Nonetheless, if you incorporate these 7 investing rules from Warren Buffett into your own strategy, it will undoubtedly enhance your long-term returns significantly. Number 1, if the business does well, the stock eventually follows. One of the valuable rules that Warren Buffett learned early on came from his exploration of The Intelligent Investor, a timeless masterpiece authored by Benjamin Graham, who later became Buffett's esteemed mentor. This rule, which resonated deeply with Buffett, is elegantly simple, yet profound. If the business does well, the stock eventually follows. This principle cemented in Buffett's mind the notion that when you invest in a stock, you are essentially acquiring a stake in the business. Over the long term, the performance of the stock is intrinsically tied to the success of the underlying business. Therefore, it is crucial to seek out companies poised for future dominance. Those that exhibit high profit margins, outshine their competitors, and enjoy unwavering consumer loyalty. It is essential to embrace the notion that investing in stocks is, in essence, investing in the businesses behind them. By diligently identifying companies with promising prospects and strong fundamentals, you align yourself with the potential for mutual growth. Remember, you need not delve into complex stock market intricacies. Instead, recognize that a stock represents an ownership stake in a business, and if that business thrives, so shall your investment. In summary, follow Warren Buffett's lead and seek out businesses destined for greatness. By focusing on companies with the potential to excel, you position yourself to reap the rewards as their successes trickle down to the corresponding stock performance. Number 2, most news is noise, not news. Warren Buffett holds an opinion that might be considered unpopular by some. Most news is noise, not news. When it comes to investing, Buffett believes that most of the news consumed is unnecessary. News programs, financial websites, and even popular financial YouTubers are primarily driven by the pursuit of high viewership, which translates to increased revenue. News programs, financial websites, and even popular financial YouTubers are primarily driven by the pursuit of high viewership, which translates to increased revenue. Consequently, they tend to create excessive hype, tension, and an overwhelming amount of news content to attract more views and, subsequently, higher profits. Buffett argues that you only need to pay attention to approximately 5% of that news. The reason behind this is that investors often allow the fickle and irrational behavior of their fellow investors to influence their own decision-making. Due to the excessive chatter about markets, the economy, interest rates, stock prices, and so on, some investors feel compelled to listen to pundits and, even worse, act upon their comments. Buffett's advice is clear. Don't worry about the pundits, and don't get overly concerned with most of the news. Instead, focus on the key and essential details that truly matter. By filtering out the noise and concentrating on pertinent information, you can make more rational and informed investment decisions. Remember, it's the quality of information that holds significance, not the quantity of news consumed. Number 3, when you buy a stock, plan to hold it forever. One financial principle I hope you've encountered before is the concept of planning to hold a stock forever. This principle revolves around the power of compound interest, which can generate significant wealth when dividends and capital gains are allowed to compound and grow over time, much like a snowball rolling downhill. By constantly buying and selling stocks, you disrupt the compounding process and potentially miss out on substantial returns, as depicted by the blue line in the graph. Hence, the key to successful investing lies in purchasing stocks with the intention of owning high-quality businesses for the long haul. Warren Buffett himself has exemplified this approach by holding stocks such as Coca-Cola, Wells Fargo, and American Express for over 25 years. As the renowned investor Philip Fisher aptly stated, if a common stock has been purchased correctly, the time to sell it is almost never. Number 4. Listen to only those you know and trust. One of the remarkable aspects of investing is that you're not alone in this journey. Even Warren Buffett, throughout his illustrious career, has constantly sought to learn from and listen to other investors. In his early years, he had the invaluable guidance of his mentor, Benjamin Graham, who taught him the fundamentals of investing. As he grew older, Charlie Munger became his trusted partner, providing additional insights and perspectives. Fortunately, we too have the privilege of learning from great investors. Warren Buffett's annual stock holdings and portfolio provide transparency, while investors like Ray Dalio and Charlie Munger regularly share their opinions and insights on platforms like CNBC. However, it's crucial to exercise discernment. Rather than listening to every pundit or new YouTuber hyping the latest stock or market trend, focus on those individuals you know and trust. Do they possess a deep understanding of investing and the intrinsic value of each stock? By filtering out the noise and seeking guidance from reputable sources, you can navigate the investing landscape more effectively. Ultimately, the principle of planning to hold stocks for the long term allows you to harness the power of compounding and aligns your investment strategy with the philosophy of successful investors like Warren Buffett. Number 5. Understand what you're investing in. Risk comes from not knowing what you're doing. One crucial rule that many people fail to follow is to understand the company you're investing in. Warren Buffett's portfolio provides an excellent example of this principle. If you examine his holdings, you'll notice that many of the companies he owns are fundamentally straightforward. Take Coca-Cola, for instance, a company that primarily sells soft drinks and has expanded into the food industry. Southwest Airlines operates in the airline business, generating revenue by selling flights. Furniture Mart specializes in selling furniture. Apple is renowned for its iPhones and other technology products. Warren Buffett ensures that he comprehends the businesses he invests in before making any commitments. Likewise, it is essential for you to follow suit. If you have an interest in cars, delve deeper and consider companies like Ford, Toyota, or Tesla. If you're inclined toward e-commerce, explore companies such as Amazon and Alibaba. For every passion or interest, there are stocks available. However, it is vital to invest only in companies that you genuinely understand. By understanding the business model, industry dynamics, and competitive landscape of a company, you can make more informed investment decisions. This knowledge empowers you to assess the company's potential for long-term growth and evaluate its risks more effectively. Remember, risk arises from not knowing what you're doing. By taking the time to thoroughly comprehend the companies you invest in, you can reduce the likelihood of making uninformed choices that could jeopardize your investments. Choose stocks from industries and companies within your realm of comprehension, aligning your investments with your understanding and expertise. Number 6. Be fearful when others are greedy, and greedy when others are fearful. The rule, be careful when others are greedy, and greedy when others are fearful, holds immense relevance in today's market conditions. Over the past 11 years, we have witnessed a prolonged bull market, with stocks soaring by over 300%. This extended period of success has led to a widespread sense of overconfidence and inflated egos among investors, as everyone seems to be making money. Greed becomes the prevailing sentiment, resulting in overinflated stock prices and a scarcity of attractive investment opportunities. This is the time when caution and fear should guide our investment decisions. Warren Buffett, a master of investing, exemplifies this approach. With over $214 billion invested in publicly traded stocks and a significant $128 billion in cash reserves, Buffett exercises a cautious strategy during these market conditions. He demonstrates a sense of fear, ensuring that he carefully evaluates the investment landscape. However, it is essential to note that as panic sets in and the stock market experiences a downturn, innate greed will come into play. When stocks are on sale and others are gripped by fear, Buffett seizes on the opportunity and begins to acquire stocks at discounted prices. This principle emphasizes the importance of contrarian thinking and emotional control in investing. While it may be tempting to follow the crowd during times of euphoria, it is often wise to exercise caution and restraint. Conversely, during periods of widespread fear and market panic, there may be lucrative investment opportunities for those willing to go against the tide. By being mindful of market sentiment and maintaining a balanced approach, you can capitalize on the greed and fear of others to make well-informed investment decisions. Remember, it is in times of uncertainty and market fluctuations that great investors like Warren Buffett seize opportunities and generate substantial returns. Number 7. Buy at a price below intrinsic value. This rule of buying at a price below intrinsic value is paramount in investing. Regardless of how great a company is, how competent its management is, or how well you understand its operations, none of it matters if you overpay for the investment. The price you pay must be below or at the intrinsic value of the asset. To illustrate this concept further, let's consider the example of purchasing a Lamborghini. There's no denying the quality and craftsmanship of the car, as the manufacturers have meticulously designed it. However, the crucial question you need to ask is whether it's worth its hefty price tag of $350,000. No car, no matter how exceptional, can justify an infinite price. The same principle applies to businesses and stocks. Warren Buffett firmly believes that no matter how exceptional a company may be, its stock price must align with its intrinsic value. Intrinsic value represents the true worth of a company based on its assets, earnings potential, growth prospects, and other relevant factors. By diligently assessing the intrinsic value of a company, you can determine the appropriate price to pay for its stock. Buying below this value provides a margin of safety, ensuring that even if unforeseen challenges arise, you have a cushion against potential losses. Warren Buffett's success is rooted in his ability to identify undervalued stocks, purchasing them at prices below their intrinsic value. This approach not only mitigates risk, but also increases the potential for long-term gains. In summary, always remember that no investment, no matter how exceptional, should be acquired at an exorbitant price. By adhering to the principle of buying at a price below intrinsic value, you can protect your investments and enhance the likelihood of achieving favorable returns. By following these crucial rules, you can develop the correct mindset and increase your chances of outperforming most investors. Remember that investing is a journey that requires continuous learning and adaptation. Stay informed, make rational decisions, and focus on the long-term prospects of the companies you invest in. If you enjoyed the content of this video, do give it a thumbs up and subscribe to our channel for more investing and money-making topics in the days to come. Thank you for watching.